Hello, good afternoon, and welcome to HYCM's online trading workshop with myself, Giles Cochran, a currency analyst. I'm going to be taking us through how to practically put into practice some of the elements of trading that we were looking at with the FX week ahead. The idea of this workshop is it's going to be practical and a benefit to you guys who are coming along. And we have quite an unusual day today, which I will explain as we go through. So it's a really good day to be looking at the workshop, and this will give you some practical ways of looking at very difficult market situations. As we start, just wanting to make clear that as I'm talking through the market, we'll be looking at various technical places, we'll be looking at various fundamental issues concerning different currencies, and just want to make it clear that nothing that's going on during this workshop is intended to be trading advice. The whole sort of aspect and the reason we're doing these workshops is to help educate traders so they can make decisions for themselves. So I trade for a hedge fund, ASAC, and what I'm trying to show through this workshop is the sort of decision-making process that I make so that you can see the sort of decision-making process that you need to make. In that way, you can make informed decisions, and this whole workshop is all about giving you that education. So just to make sure you're clear of how it goes. And as we're kicking off, let's just see who's here and say hello to a few folks. Oh, hi Nadir, welcome back again. Hey Tan, Ramesh, Stanley, Ifam, good to have you guys on board. And yeah, hi Tan. That's great. And Ifam, lovely. Can you just let me know that you can hear me okay? Yeah, hi. Thanks, Nadir. You've already beat me to it. You know my question. Thanks. I'm glad you can hear me okay. So that's good. Everything's being heard. Going through to the session ahead. The first thing to realize in the session ahead is that we have a handout. And if you go to your GoToWebinar control panel, you'll see a little gray arrow. And next to that little gray arrow is a handouts, 1 out of 5, it should say. And if you open that handout, 1 of 5, there's a workshop guide entitled 15th of Jan. If you open that up, what you should see is this form here. And you can see the special event that we're looking at today is how to use the US dollar index in your trading. We're going to be covering that during the session. Very helpful index for trading the US dollar. You can often get some really good clues about the direction of the US dollar just from looking at the index. So I'll be going through how to use that in your trading and how that can be a real benefit to you, particularly if you're trading the euro US dollar pair. The US dollar index is a really helpful tool. We're going to be looking back, looking forward, looking at the charts, looking at risk, and looking at the outcome of your trade. The reason I've chosen these items, 1, 2, 3, 4, 5, is that these are 5 good background ideas for you to have in your mind every time you look at the market. If you look at the first one, looking back, which is what we'll look at in a minute, it just shows you how to go about applying some of the skills that you need for trading. So have that, and don't forget you can print that out and you can use it again. I will be referring to it during the session, but just for now, have it open, print it out, and then you can leave it by your desk and you can use it as a template for your trading for the rest of the week. The idea is just one side. I don't want to make it too big. I don't want to make it impractical. It's just one piece of A4 that should have enough prompts on you to help you to start knowing how to make a trading a framework for yourself. Now, we can do specific topics that people would like. So if you go to workshop@hycm.com, if you email suggestions there, then those suggestions come through to me, and I have already received some suggestions. We'll be looking at dealing with them during the course of this year, certainly during the first part of this year. And if you have anything in particular that you really want help with, just email the suggestion. You could even do it right now before you forget. It's workshop@hycm.com. send that through, and I'll be more than happy to help you with anything that you're struggling with, or just something you want a little bit of advice or guidance with. So send that across to me. The whole idea of these workshops is to help you as traders to trade successfully. That's what we want. So that's what the aim of this whole time is. So without further ado, turn to your handout, and your handout, I've just put a the framework here, and we're going to start to look at the first section, which is looking back. And as I've said a number of times, when you come to trade, you don't want to just jump into a trade as soon as you open up the charts. You don't want to just see the price at a technical level and think, oh, I'll just jump in there. No, and before I even start executing trades, I don't even open up my MetaTrader 4 terminal. I just leave it closed, because first of all, I want to look back. Now, I want to look back because I want to understand the context of what's happening in the market. So if you can see here, underneath look back, it says identify recent sentiment by reading up on the last 2 sessions of market activity. So in other words, what you want to do is you want to find out, but what's market sentiment, if you're wondering? It's simply the mood of the market. So you want to find out what has been having the most impact in the market over the last 2 sessions. What is the market focused on? And the market always likes to focus on things. It's either something that's very risky, or some very good news, or some very bad news. The market's very emotional. It tends to swing in large directions, and then can quite often swing back in equally large directions. So the market is emotional. So we need to understand, as foreign exchange traders, what is the market is focusing on. And before you can know what the market is focused on, you have to identify it. Okay, so you have to do some research. You have to read up and see what the market is doing. Now, this is not a particularly hard skill. It's just something that takes time. And like all skills, the more you exercise them, the better you get at them. So this is why I've done the handout, because this can be a guide for you to use on a day-to-day basis. So here we go. Now, the biggest, the largest issue that we're going to have today is Brexit. Now, as I said, today is a little bit different to normal days, and we'll be looking at this why this slide is relevant later. But for now, I just want to really focus our mind that this is an unusual day. There's going to be Brexit issues that are going on throughout the day, and it's out of the ordinary. So just to be aware of that. And the good thing about this being out of the ordinary is you've got a workshop on an out of the ordinary day. So I'm going to be showing you some of the big kind of issues that you need to be aware of during an extraordinary day, and that's going to help you to know what kind of risks and opportunities are involved with this kind of day that we have ahead. So first of all, we are going to learn a lesson from yesterday's US session, and this is a key lesson to learn with reported news. News can be wrongly reported, okay? News can be wrongly reported. Though this is what happened yesterday in the US session. It was the second half of the London session and the US session. I was at my desk and I was looking at this at the time. And what happened is the news was wrongly reported. What happened? There was an initial report that came over the wires. I think it was an ITV report, which is a British news organisation, a respected one. It's BBC and the ITV are 2 of the largest news organisations in the UK. And it was the ITV. And the news was that the ERG Brexit group was prepared to vote for May's Brexit deal, and thereby giving it key support. So obviously one of the key issues for Theresa May is, can she get her Brexit deal voted through the UK Parliament? It's widely expected that she won't be able to. However, so when this news came out, the fact that she might be getting some extra support for it, it meant that people were buying the pound, because if May's Brexit deal is accepted by the UK Parliament later today, the pound will appreciate maybe as much as 700, 800, 900 points. We're looking, especially over time, we're looking at the pound rising to about 1.38 on the back of the end of the Brexit deal. being organised and all sorted. So a lot of potential for moves. And of course, one thing that foreign exchange traders always want to do, they always want to get in at the earliest possible moment. So as soon as this report came out, obviously traders thinking, can I get in early to any appreciation in the pounds? And this is the result on the 1 minute chart here. This is as the news came out on these two candlesticks here. The news came out and it spiked up to 1.2930, okay, on that news. So it's about, roughly a 50 point spike just on that news. And the lesson is that news can be wrongly reported, because once that initial report came out, I then saw on the Reuters feed, which I was looking at the time, so the actual details that this would only be the case if Hilary Benn's amendment was accepted. So in other words, it wasn't quite as good news as was expected. Okay, so let's go and look at the pound US dollar chart and see how that played out, because I was explaining yesterday the pound was in a really interesting point. It was appreciating because people were sort of expecting maybe Article 50 to be extended and there'd be some short-term relief in the pound. Once you were following this, it was quite clear. And if you can see that I was highlighting this 100 exponential moving average here would be a good place to define and limit risk. And so when the news came out yesterday, it was this 1 hour candlestick here. It came out, price spiked up to 1.2930, and then it sold off. And the reason it sold off and has now gone back through the lows of that report was for the very simple reason that the actual report was misleading and wasn't helpful. So the first thing to be aware of, and this is particularly when you're trading headlines. Now, if you want to get into trading headlines, you will need a news feed, and you'll need a good one. So there's various sources you can use. You need to follow things like the ITV News, BBC News. Sometimes those kind of situations can trigger it, but usually what happens is there's a squawk. So people use a RAN squawk or a live squawk, and that squawks out the news, okay, and it helps traders know what significant moves are happening. But this is just to show that sometimes the initial report comes out one way and then it's quickly clarified or denied, or the reality is not quite as good as it seems. So that was just a good lesson to learn from yesterday's US session, okay. The other thing to be aware of yesterday's US session is that the partial government shutdown is now entering its longest ever period. It's now in its 25th day, okay? So you may have picked this up. US government has shut down. It was shut down yesterday. This is having an impact. It's a partial shutdown. So this is something that traders are aware of and following. And you might ask, well, what is the US shutdown all about? Well, what's happening here? It's all about President Donald Trump and him wanting to build his wall along the US-Mexico border. He's been planning on building this wall for as one of his election promises. So for President Trump, it's very important that he gets this wall built. The problem for President Trump, he's a Republican, is that prior to last year's US midterm elections, President Donald Trump, Republican Party, had control of all of Congress. That's the House of Representatives and the Senate. For those of you who aren't aware the way the US Congress works, Congress is essentially like their parliament, and Congress is split into two different houses, two different parts. It's split into the House of Representatives, sometimes just known as the House, and also the Senate, those two parts. Now, prior to last year's US midterm elections, the Republican Party controlled the House of Representatives and the Senate. However, with the US midterm elections, President Trump's Republican Party lost control of the House of Representatives. So now we have a split. So the House of Representatives are Republican. The House of Representatives have fallen to the Democrats, and the Senate is remaining in Republican control. So at the start of the year, one of the key roles of the US Congress is to vote through budgets for the coming year. But of course, President Donald Trump wants his budget for building the US-Mexico wall approved. However, because his party no longer has control of the House of Representatives, it makes it much harder for him to get that vote through. So all of a sudden, Trump is struggling, and so Trump has, forced a partial government US shutdown because he's not wanting to continue and to approve the budgets until his wall is budgeted for. So that's why we're now entering the 25th day of shutdowns. It's the longest ever shutdown, and it's just worth reflecting on what this means. Well, it means that according to the S&P 500 global ratings, I think within a couple of days, they were forecasting that it's going to be costing $6 billion for the US economy. So that is almost the price of the wall itself. I think he wants about $5.37 billion for the wall. However, just to put it into context, this is a list of all the government shutdowns since 1976. Okay, and these are the number of days that the government has been shut down. And it's just worth recognizing that the median average of all of these government shutdowns impact on US equities has been 0%. Okay, so the average impact is minus 0.6%, and the median average is 0.0%. So it kind of sounds scary, but it's not having a massive impact on the US equities, the S&P 500. You can see the impact there. So that's just worth bearing in mind. And for any sort of equity traders, I just came across some very interesting information. It's that there's an 80% chance that the Standard & Poor's 500 will close up in 2019. Now, this isn't for short-term trading. This is for medium to longer-term trading of US indices. But it's just really worth seeing something called the 5-day rule. And the 5-day rule is that if the S&P 500 rises in the first 5 trading sessions of the year, it will end the year higher. So that has in fact now happened. And in fact, there's another rule that says if it's a positive January, the S&P 500 has a year-end success rate of 86%. And that's just quite interesting given the huge drop-off in US equities at the end of last year, particularly over concerns of US growth. Now, obviously, statistics can be wrong, and I wouldn't recommend trading blindly on statistics. It was just more an interesting statistic, particularly with the US government now in shutdown, and the fact that the S&P 500 did have 5 up days on its first 5 trading days, and we're currently positive in January, heading into the middle of January now. So one's just to look and notice, and one to take note of. Now, in the Asian session, there was some interesting news out of China that moved the market. They basically said that there's more stimulus to come. They're going to keep economic operations within reasonable range. They're going to continue to implement proactive fiscal policy. They're going to be prudent. They're going to implement larger tax and fee cuts in 2019. All of this is business and growth positive. They're going to ease funding difficulties for small and private companies. So they're going to make it easier for companies to get access to loans, etc. They're going to deepen reform of the state capitals, state-owned companies, and they want to strengthen monitoring of economic situation and improve policy reserves. So in other words, China is saying that they're really they're going to give more stimulus to the economy. Okay, so that was a good news overnight. They also said that it's going to boost fiscal expenditure. So we've had that implementing larger tax cuts, fee cuts. They're going to step up fiscal expenditure. They're going to increase bond issuance to support key projects, and the government will reduce its general expenditure by more than 5%. So all of this is growth positive for China, and this is particularly important because there have been concerns that the market has been really focusing on of global growth slowdown, and China was kind of seen as the kind of initiator of this global growth slowdown. And in particular, it was the US-China trade war that was seen as responsible for slowing China down, which in turn would drag on the whole global economy. That's the kind of bigger picture concern that the market's been having. And if you look at those latest Chinese import and export data out the day before today, so for Monday, and this was the concern here. I'll just show you the data. The concern here was that exports were down not 0.2% year on year versus a 6.6% expected. So that's a big miss. Okay. Now, part of that, now that was expected to fall, the imports, because the exports rather, because of companies front running lots of extra orders before the US-China trade war really took into place. People were trying to dodge the tariffs. So that was expected to fall, but not expected to fall that much. And also, we saw this interesting data was the imports falling minus 3.1% versus a 12% expected. So that's the goods that are being imported into China. And of course, this is a good indication that Chinese consumer confidence is falling. There's less imports. People are buying less products. And it's an indicator that things are slowing down. You know, they're exporting less, importing less. The economy, these are signs that the economy is shrinking. Okay, so that's why the kind of assurances from China that they're going to be boosting fiscal stimulus, boosting business, trying to cut waste, increase expenditure, bond issuances for major projects, making it easier for smaller and medium-sized companies to access funding. All these things are business positive, and that's just showing that that's coming in that context of a concern. And obviously China's a bit concerned themselves, hence they're trying to push the extra stimulus. So that's just to give you way of context. Now the reason that, and also on top of that, there was more progress made on US-China trade war talks. So you kind of have this buoy over the night, over the Asian session. When you look at it, you can see, okay, and as a foreign exchange trader, you're thinking, okay, well then, what does that mean? Okay, well, what it means is that that's positive news for the financial markets. Obviously, if the market's concerned about global growth and concerned about the US-China trade war, if those talks are going well, then that's going to start bringing some relief in. Also, if China is looking like it's going to be responsible and really on top of any export and import falling, any shrinking in business, then that is going to be good for growth and risk as well. And so the Nikkei, which is the Asian indice, closed up nearly 1% at 0.96%. A good rule of thumb is when indices close up over 1% or 1% and above, that's significant. Okay, so the Nikkei closing up nearly 1% is a significant increase. And this is what we saw in that risk-on sentiment then flowed in to the London session early this morning. Okay, so which currency do traders, this is a question for you guys just to try to keep it interactive. It's a little bit harder today to be interactive given how unusual the market circumstances are, but here's a question I can ask you. Which currency do traders tend to buy when they're concerned? Which two currencies, when there's a risk off situation, when the market is really feeling adverse to risk, concerned about some major event, which two currencies do they buy? Which two are the major currencies that they buy? If you can just put that into the question box now, if you're able to, just type the answer in your box. Which two currencies do people buy? I'll give you a second. Okay, Trip, a good attempt. Now this is when, yes, Ifam, that's exactly right. The two currencies that people buy when they're concerned is the Swiss franc and the Japanese yen. Okay, so what we saw in the London session, we saw that the market was in a risk-on mode. Okay, so because it's on a risk-on mode, it's not going to be buying the Swiss franc and the Japanese yen. Okay, it only buys the Swiss franc and the Japanese yen in a risk off situation, when it's really concerned. So obviously that data out of China meant, okay, the currencies are, the market participants are less concerned, they're less worried about what's happening. And so what tends to happen then, you tend to see the rise in commodity currencies. And you can see those commodity currencies here: the New Zealand dollar, the Australian dollar, the Canadian dollar. They tend to be the stronger currencies when it's in a risk on situation. Okay, so this is just a good lesson for you to learn. So in a risk on environment, we see the commodity currencies bought: New Zealand dollar, Australian dollar, Canadian dollar, and we see the safe haven currencies, the Japanese yen and the Swiss franc, being sold. I hope that's clear for you. It's a good lesson, and it's one that will serve you in good stead, and it's a good rule of thumb to be using when you come to the market. And you can look, you know, sometimes you can just look what's the strongest and what's the weakest currency, and that can give you a clue as to how the market is feeling just by looking at the commodity currencies and the safe haven currencies. So in the London session, that's what happened. Okay, we had the risk on environment: New Zealand dollar bought, Australian dollar bought, Canadian dollar bought, yen sold, Swiss franc sold. Okay, now the pound is the top of the list there, but that's for different reasons. And the pound is being at the top because of the unusual circumstances surrounding Brexit. And remember, market participants are continually trying to get in early as possible. People are desperate for that little bit of news that indicates the result is going to go one way or the other. And that's when you see large, quick moves in the market as people try to take advantage of that. Now, as I said, the Brexit is in key focus. And trading today, you cannot ignore Brexit. And if you're trading the pound, it would be disastrous for you to ignore what's happening in Brexit. Now, to provide a little bit of context, just to remind us that Theresa May is leading the British people to leave the European Union. The date for the official leave of Britain and the European Union is the 29th of March. That, as it stands, is the definite date at which Britain leaves the EU. However, the question is, how will Britain leave the European Union? And this is what market participants are trying to see. Theresa May has been trying to establish a specific deal with the European Union that promotes price stability and is a good relationship between Britain and the EU going forward. That's called Theresa May's Brexit deal. That is what is being voted on today. It's Theresa May's Brexit deal. We'll look at the timings of that later, but for now, it's just sufficient to be aware of the broader picture. Now, the latest numbers are saying that, well, it's been known for a long time that Theresa May is expected, and I use the word expected because this is politics after all, anything can happen, but she's expected to lose the vote that takes part today. Now, she did have a vote in December, which was postponed because Theresa May knew she'd lose it, and she postponed it, trying to get some reassurances from Europe concerning the Northern Irish border. There's a problem concerning the Northern Irish border and Britain's ongoing relationship with the European Union. Now, the issue is that because the Northern Irish border borders a European country, Southern Ireland, in theory, there should be a strong, what's called a hard border erected along that physical border. However, in Britain, there has been sort of a lot of sectarian violence between Southern and Northern Ireland. It's a very politically charged situation. So constructing a border back along that divide would be politically very disastrous and would be reversing some of the Good Friday Agreement that brought a lot of stability and peace in the Irish Peninsula. So the question that May's trying to really establish is, can she get that vote through? These are the latest numbers out of Reuters. So there's 317 voters for May's Conservative Party. She only has a working majority of 13, and that's thanks to a deal with 10 members of Parliament from the Irish Democratic Unionist Party, the DUP. Okay. Now, she has 44 people who will support the deal, plus the 100 that have to agree to support her. But at the moment, opposition is 115, including 34 of May's Conservative lawmakers. So she's got a majority of 13, but 34 of her own party are going to be opposing the deal. So at the moment, she doesn't have a majority. And Theresa May is expected to lose the vote. So what we'll be looking at is some of the alternatives and options that there are should Theresa May lose the vote. Before we do, we'll just look at the overnight volatility. So this is the overnight implied volatility for option traders, and you can see here that overnight the volatility has soared up to 26.4150. So that it tells you that option traders are expecting a very volatile day in the pound, and we're looking at around, well, we're looking at around certainly we're looking at a 1% move on the pound US dollar in relation to, just for today, in relation to this options implied volatility. So that's just telling us there's a lot of risk that's in the market. The other news that came out is Germany's Mars says if the Brexit deal is rejected today, there could be new talks with the EU. So this is important because it's widely expected for Theresa May's deal to be rejected. One possibility is she could renegotiate the EU deal. Now, the EU themselves have said they're not going to change the terms of the deal, but they might clarify the terms. Now, obviously, this is politics. And politics can take many different forms, and it can be quite difficult to anticipate what people mean, and particularly as people sometimes deny what they're going to do just before they do it. Now, some of that is, it can't be helped because of the nature of politics. You can't say too early what you're going to do, and it's not all cynical. But however, what traders are trying to work out is if there is a renegotiation, would that be accepted by the EU? Will that then be voted through Parliament? And there is one option that is emerging, which I will share with you. There's been some bank recommendations regarding the euro. SocGen and HSBC have been advocating some selling of euro. Well, certainly SocGen invited selling of the euro, and this is the slowdown in the eurozone that's carrying on. They're expecting that to start to be acknowledged by the ECB. So that was out recently. We also had, now this is another good lesson for us all, because we've been seeing at the start of the London session that trade was very much, it was in this risk on sentiment scenario. However, what happened, JP Morgan released some of their latest figures, and their revenue was 26.1 billion, down from expected 26.86 billion, and that means their sales and trading revenue were down 1.86 billion versus 2.29, and their Q4 adjusted figures was 1.98 versus a 2.21 estimate. So this was JP Morgan's share price, and it dropped quickly on this news, and so this affected sentiment later on in the London session. Obviously, the earnings of such a major bank is going to have an impact on risk, and you can see that you can see that the yen was being bought on the back of that news here. So we'll just So there we go. So we saw that the yen was sold off, was being bought rather. US dollar, Japanese yen pair was sold, yen being bought. And then price, if you notice, just sort of settled and nestled on this 100 exponential moving average and 50 exponential moving average, found some buying support, ripped up, and is currently falling back down to the 100 and 200 exponential moving average. So we're in a state of flux at the moment, and the market is trying to really does it carry on with that risk-on sentiment from the Asian overnight session and early morning London, or is it going to go with the risk-off sentiment with the the JP Morgan concerns about Brexit, which is going to affect the pound and the euro? So there's a lot of risk, and the market kind of picture is quite murky. Now, this is one of the big lessons that we've got today. And one of the big lessons we've got today is the volatility that we can expect with the pound. Now, this was the Thomson Reuters chart, which kind of shows you where orders are on the pound US dollar pair. Now, there was a crash of the pound US dollar pair in 2016, and it sort of fell 700 points in about 60 seconds. And this shows you the dangers of the volatility. Now, if you look at the blue arrows, you see those little blue arrows. Those blue arrows are sell orders, and the green arrows are buy orders, okay? The shaded areas, you see these shaded areas, this red, orange, the yellow here, the red. These are limit orders. So that's a buy limit order, that's a sell limit orders. And if you notice, what's particularly interesting is I want to show you these white areas. Now, these white areas are areas where there are no orders. Now, this flash crash happened in the time between the end of the US session and the start of the Asian session. Okay, so it's quite an illiquid time, and it's known for being quite illiquid. And there's an increasing phenomenon called algorithmic traders. It's just an automatic way of trading that many big banks they use. But in extreme conditions, they will turn themselves off. So you can see, look, in the minutes leading up to the flash crash, there were lots of orders in place. There was $60 million worth of orders in that time frame. Then all of a sudden, they literally disappeared. Okay. And the reason they disappeared is because the algorithmic traders can turn themselves off. So that means that we are in a new era when you can get flash crashes much more easily. There can be times when you can't get a fill because there aren't any orders to put your order against. So just in terms of, we're looking at the volatility, we're looking at the potential danger of the pound, you can see that actually any trading of the pound at the moment is very vulnerable to this kind of phenomena. Okay, so there can be large price jumps, there can be price gaps, and there can be illiquid patches where it's just impossible for your order to be filled. So that could mean that your stop order is not able to be executed properly. It could also mean that your limit order is not executed properly. So there's something here called event risk. Okay, it's event risk, and I will briefly show you how to manage event risk in a way that's something you can do. Now I'm going to look forward. What do we see coming ahead of us? Obviously, we've got the Brexit arrangement, the Brexit deal that's coming up. I've had a quick look here to show you what's going on. This is ukparliament.uk. You can see what's happening in the coming session. So 15th of January, here we got the order paper. We can look what's going on, and we can see, look, okay, so what we've got today in the main chamber, we've got questions, urgent questions, and then until 7 p.m. there is the Section 13 1B of the European Union Withdrawal Act 2018. Now, this is when the Prime Minister is proposing that the House approves the purpose of the Section 13 1B of the European Union Withdrawal Act, the negotiated withdrawal agreement laid before the House with the attachment. Okay, that is what's being voted on. Now, you see these various amendments. Okay, now these amendments could cause the vote to be lost before it's even taken, because the amendments, some of the amendments are actually against the whole deal. So Jeremy Corbyn's amendment, he wants to leave out from that and insert declines to approve the negotiated withdrawal agreement and the framework for the future relationship because it fails to provide for the permanent UK. This is Jeremy Corbyn's amendment. And so if his amendment is accepted, then there'll be no point voting on the Prime Minister's amendment because she's lost. Okay, so you see, so an amendment can upset the vote before the vote even happens, to be aware of that. And the amendment that's very interesting that I want you to look at It's an amendment here. It's by, show you it. It's by, not this fella. Yes, it's the Morrison Amendment. And what Morrison is proposing is that alongside Theresa May's Brexit deal, she says she wants to add the end of the motion to subject to the withdrawal agreement treaty being amended to specify that the backstop solution shall expire on 31st of December 2021. So if you remember, a lot of the controversy about the UK arrangement that Theresa May had established was how long would that backstop arrangement go on for? And it could go on in theory indefinitely, but what Morrison is saying, well, let's put the expiration, it's called a sunset clause. In other words, there's a time when this agreement fails to apply. Let's make sure it expires on this date. It's a very good solution. And so that could itself be enough to rescue Theresa May's deal. I could see that potentially being very helpful. And if that amendment was accepted and voted on, then maybe that would provide a limitation to the backstop deal, and maybe Theresa May would get enough votes. Now, obviously, I haven't got a crystal ball. I can't see what's in the future, and unfortunately, that's you can't see what's in the future and so what you have to do is you have to see the risks, define them, limit them. But I could see a situation where the market is surprised and the pound is bought very heavily on the it would be bought very heavily if Theresa May vote is accepted. Now, the actual timing of the vote is hard to pin down, but it's going to be sometime between like 9 or 10 o'clock GMT, so somewhere between 2100 and 2200 GMT. It could go on a lot longer. This is a very politically charged situation, so timings can't be accurate. You can see here some more yen buying, so market is erring towards that risk off sentiment for now. But looking at the pound, let's look at the chart and show ourselves now. Now, what you need to look at is if you were looking, one of the ways to trade high risk events, okay, is first of all, you always use a stop. That goes without saying. You should always use a stop. But secondly, you just use a much smaller position size. Okay. So by using a much smaller position size, if you do get some jumps in price, then you can allow for those jumps in price. So, if you're normally trading sort of 30, 40 point stop, if it's a very high risk event, then you might want to extend that to being 100, 200 point stop is your normal position size. So you don't increase your risk, you just increase the size of your stop. Now, the other thing to look at is, say, for example, Theresa May, this is what I would be doing. Say all of a sudden the Brexit deal gets organized, okay, and is approved. So that would have a strong reaction to the pound. I expect the pound to move from current prices up to 1.38, okay? So here, around the 200 exponential moving average, I would see that as the obvious first target, okay? So if that was the case, if Theresa May's deal gets rejected, then I'll be looking at entering long. Now, the thing to check is to check the spread. Okay, because when that happens, the market will be very volatile. There'll be huge amounts of orders, but check what the spread is. Okay, because if that spread is huge or an enormous, an enormous spread, then you don't want to be trading that. And if you're unsure, then stay out of the market. However, that is one thing to look for. And if you miss the initial move, so if Theresa May's deal is accepted, you're going to see pound positive. If you miss the initial move, don't worry. You just look for technical places to rejoin longs, and there will be lots of them coming up. So it's not a question of if you miss the announcement, you've missed the appreciation of the pound. That's likely to go on for some time, and there'll be plenty of other opportunities to join that move. But if to get in early is can be a really good advantage. And these kind of trades don't come around every day. Okay, you can see the pound here. This was the pound sold on the Brexit vote as Britain unexpectedly left the European Union. and you saw that huge, that huge in that whole week at that huge 1.5 down to 1.3 nearly, near 2,000 point move, and then you saw the corresponding move going on after that, all the way down here to a lows of 1.18. So we can see the kind of moves that could be expected. These are the kind of moves that could be expected today. And then as soon as that happens, so if that happens, that's clear. If it doesn't happen, if May's deal is rejected, there could be a second, a renegotiated deal. There could be a referendum. If it goes down to a referendum, that means Britain's less likely to leave the European Union, and the pound's going to appreciate. Okay, so be aware of that. A general election, I think, is a little bit more complicated. If the general election is called, I could see a sell-off in the pound, followed by the pound being bought as the pound anticipates a general election with Labour government either promoting a second referendum or rejoin the European Union. Okay, so it's a little bit more murky if Theresa May's deal is rejected. So you have to see what the actual detail is, and there's a lot of different variables. So there's a lot of uncertainties. We've gone through the volatility. We've shown the risk. So that's things you have to be aware of as you're looking. And you might decide, I'm just going to stay aside. I'm not going to be trading the pound during this event at all because it's too volatile. Remember, if you are trading, you have to allow wide stops given the huge moves, and remember the illiquidity. So remember that happened between the end of the US session and the start of the Asian session. And remember, what time is the UK vote expected to be done? Well, it's going to be done around 9, 10 o'clock, so 2200 GMT. It was only a couple of hours after that this flash crash happened a couple of years ago. So be warned. And if it's an illiquid time, then the market could move in extreme moves, and there's a liquidity there. And that's not to do with your broker. That's not like, oh, I've got a bad broker, I didn't get my fill. This is to do with illiquidity. There just isn't the orders there. Okay, so you can't give what you haven't got. And remember, every currency trade has to be traded with an opposite. So if you're selling, it's going to be paired with someone who's buying, and vice versa. And if there's just no one there, then there's no one to fill your order. Okay, so just to be aware of that. I know sometimes traders get upset and they think, oh, my broker didn't give me a fill. Actually, there wasn't a fill to be given. So the Swiss National Bank, a plummet of 1.20 was a perfect example, and lots of big brokers collapsed and completely failed, and it wasn't anything other than the fact that there was just lots of liquidity. There just wasn't the orders to be filled, and huge fortunes were lost and companies were lost. So don't allow that happen to you. You may decide, I want to totally avoid it altogether, but if you are trading it, make sure you certainly don't use any leverage, and use negative leverage to allow for large stops and large moves. We've also got Draghi speaking 3 o'clock today, potential risk for the euro. And remember, there's potential risk for the euro with the Brexit scenario as well, because if there's no deal organised for Britain, it's also bad for Europe. Particularly Germany, they want to get their imports, their exports rather, to the UK market all sorted. If there's no deal, or that looks like a hard deal or a no deal Brexit, that's bad for the euro as well. So Draghi speaking at 3 o'clock. As I said, a couple of banks are starting to say that the Eurozone's in quite bad shape. It's been slowing down. It's getting worse. ECB is due to hike interest rates next year once. Some banks, SocGen and HSBC, I read today, are beginning to question that narrative and saying that obviously this is not necessarily going to happen, but the fact that they're starting to question it shows there's a negative drag on the euro. Will Draghi address that today? He's not specifically addressing monetary policy, but is likely to touch on it. So got to be aware of that, particularly to trade in the euro. 3 o'clock, he's due to speak. We have we've done the looking forward. We've got the Brexit deal coming up. We've got Draghi speaking at 3 o'clock. We've got US PPI data coming out at 1:30. So that that may be out now. I haven't looked on those figures, but obviously the markets, the dollars are at a crossroads at the moment. Federal Reserve are going to be more data dependent. So, you know, a miss on that is going to mean more drag on the US dollar. So that's coming up. It may be delayed because of the partial US shutdown. So if it isn't out yet, that's what's going on there. We have the currency bias for the session now. We didn't cover that this time because it's so unusual. Okay. One, where sentiment is sort of changing. We're midway through the session. Two, we got the Brexit focus, which is just really sort of twisting the market at the moment. So I'm not looking at trading any particular currency pairs at the moment with such high risk going on in the market. Just again to flag two key zones. There's a resistance zone 1, resistance zone 2 that corresponds to the 100 and 200 exponential moving average. We're in that kind of zone now, and then there's 200 exponential moving average just above. Just places to define and limit risk and targets. Just worth recognizing those. And then looking at your risk. Something we often I've done special webinars on this, but just a reminder that make sure you're using leverage correctly. In my opinion, you should avoid using leverage or limit your leverage severely. It's one of the biggest ways that traders lose their accounts is by using too much leverage, and it's the single best thing that you can do to limit and give you your success in the financial market is limit your use of leverage. So what I recommend is, say you have a $10,000 account, then if you're not using leverage, you will be trading with one mini lot. So that would be 0.10, okay, lot size. That will be trading without leverage because your position size, $10,000, one mini lot, 0.10 of a full lot, is equivalent to your account size. So particularly with a Brexit going on, do not consider using leverage unless in a very specific situations when you're absolutely sure of the outcome. So an unexpected interest rate rise, or maybe, you know, if the conditions are correct and Theresa May's deal is unexpectedly voted through, that could be an opportunity to use leverage. But I personally would only use twice my leverage. So I would only use double that leverage. So if I had if I was trading a $10,000 account and I wanted to use leverage, I would only use a maximum of 0.20 position size, which is more than enough to be making a profit. And if you can make monthly profit percentage-wise, then you can add to your capital and grow your business and grow and grow and grow. What you can't do is if you lose all your capital, you can't grow your business. So today's particularly important to make sure you're using a leverage correctly and keeping a nice stable trading environment for yourself for the future, which gives you opportunities, but also limits your risks. Okay, now, quick helpful topic for you guys. How can the US dollar index help you in your trading? Now, this is a picture of the US dollar index, and you can see the US dollar index here. It started in March 1973 for a value of 100, and in February 1985 it hit just under the 130 level, and then in March 16, 2010 we've got a sort of an 80 level that it hit. And you know, at the moment the US dollar index is it's 95.78. That's where it is at the moment. So how can this dollar index help you in your trading? Well, first of all, what is the dollar index? Well, the dollar index is a measure of the US dollar in relation to a basket of other currencies, and it's in relation to a basket of some of the US's most important trading partners. So some of the most important trading partners are the euro, the yen, the pound, Canadian dollar, the Swedish krona, and the Swiss franc. So the dollar index is constituted and weighted in this way, okay? So it's given a 57.6% weight to the euro. So you notice that's the biggest weighting. And then 13% plus to the yen, just under 12% for the pound, just under 10% for the Canadian dollar, just under 5% for the krona, and 3.5+% for the Swiss franc. Okay, so that is the way that it's weighted, and you'll see straight away that the US dollar index is weighted heavily in relation to the euro. Okay, so this tells us that the US dollar index is virtually the same as an anti-euro index. So what this means, when the euro loses value, the dollar index gains value. Okay, and the nearly 60% average weighting means that the euro-US dollar pair and the US dollar index are inversely correlated. So let me show you what I mean by that. Okay, here's the euro-US dollar pair. You can see the euro-US dollar pair since May 2016 has been on a steady and continuous downtrend. Okay, you see price respect the 200 moving average, sold off from there, and price has just recently hit the 200 moving average and has sold off again since I did this screenshot. Now, in exactly the same way, you can see this is the US dollar index from May 2018 up to present day. You can see how they're inversely correlated. The euro-US dollar pair is going down. Oh, the US dollar index is going up. They are inversely correlated. So that means that when you want to, if you're trading the euro-US dollar pair, you can look at the US dollar index. So let's look at that now. We'll go to the dollar index and we'll see, okay, dollar index has been rising today. It's 0.18%. So what would we expect the euro-US dollar pair to have been doing today? So if put it on the questions, guys. So we've got the dollar index rising. What would we expect to see the euro-US dollar pair doing today? Thanks, Nadir. Top marks for you. Down. That's exactly right. Exactly right. So let's go and look. So US dollar index pair is increasing. Let's look at the euro-US dollar pair. Just call it up here. So euro-US dollar. We'll just pop a template on. That's it. So you can see the dollar index rising, the euro-US dollar pair is falling. So you can look at the dollar index for clues about the direction of the euro-US dollar pair. So a good one for me was when I was looking here recently at the reaction of the euro-US dollar pair around the 200 exponential moving average. And what I saw in the US dollar index, the US dollar index was inversely correlated on the 200 moving average, and it was selling off and below. It was working in the exact opposite way to the 200 moving average, and it gave me a clue. I thought, I know as the dollar index is breaking out of its 200 moving average, I know that this is going to be selling off. So it gave me a clue on the future direction of the euro-US dollar pair. So just put that in your bag and look at that. Look at the US dollar index. Consider it. So here it is. It was around this time here. You see, it was when the US dollar index started to be bought up off the 200 exponential moving average, and that gave me confidence that the euro-US dollar was going to be sold off. Okay, that happened real time. It doesn't make much sense from this, but that gives you the rough idea of it. And the other thing to use the US dollar index for is this simple point here, is if the base currency US dollar, the US dollar index and the currency pair normally moves in the same direction. Okay, so if the US dollar is the base currency, so let's take US dollar Swiss franc, the US dollar and the currency pair normally moves in the same direction. So if we want to look at the US dollar Swiss franc pair, this might be slightly trickier because of the sudden change in risk sentiment, but we'll see. So dollar index is up 0.2%. So we'd expect the US dollar Swiss franc pair, we'd expect that to be rising as well. Let's have a look. Yeah, here we go. Here's the pair. Right, we'll open her up. And you can see that with the US dollar index rising, we've also seen the US dollar Swiss franc pair rising. So you can use this US dollar index as a little tool to help you know where the currency pair you're trading is using. So you can see at the moment the dollar index, you can see why I have it just easily accessible to myself, 95.81, there it is. The US dollar index, if the base currency, they normally move in the same direction. And conversely, if the US dollar pair is the quote currency, sorry, that should be the other way around, then the US dollar index and the currency pair normally moves in the opposite direction. Okay, so that's as in euro US dollar pair. That's the prime example. So there you have it, guys. That is how to use the US dollar index in your trading. I hope you find that helpful. Make sure you use it, particularly if you're trading the euro US dollar pair. Just looking at the US dollar index is going to really help you, and you can get some good technical clues sometimes as to what the near-term direction is. And when you combine that with fundamental knowledge, that can be really helpful. So why not check out Draghi at 3 o'clock later this evening and see, how the euro moves and how the US dollar index moves at the same time. That will maybe provide a good way of following up, and maybe you can notice some observations. But you'll see that the weighting of the dollar index, 57.6% weight to the euro, means it's sometimes referred to as the anti-euro pair. Okay, it does the opposite of what the euro does. Well, that's great, guys. We've come to the end of our webinar. As you can see, it's slightly different today because of the unusual circumstances which we're facing. Very large risk events ahead, a lot of volatility expected. So trade very carefully. If you trade at all, you may just stand aside and wait for the reaction tomorrow. Well, there will be plenty of action ahead for sure. So sometimes staying out of these market situations can be the most prudent thing to do. I hope you have a really good day, and don't forget, come back next week, 21st of January. We'll be looking at the FX week ahead, and I dare say we'll be looking at some of the fallout from what's about to happen this evening. Have a great week. I look forward to seeing you in the future, and thank you for attending HYCM's online trading workshop with myself, Giles Coughlin, and I hope to see you guys in the future. Take care. Yeah, great. That's true. I'm really glad that's helped. That's really super. And yeah, great. You're welcome, Nadir. Good to have you as always. Take care now, guys. Goodbye.